So first, let me tell you that I ran the numbers and found that the startups in the Southern California area that goes down to about San Diego and up to Santa Barbara got about half the investment dollars last year that they did during 2008. That's about $2 billion invested in the region during 2009, down from 3.8 or so billion invested the prior year. I just want to start by asking all of our panelists, how many fewer deals did you do in 2009 than in 2008 or in 2007? Marc, do you want to kick us off?
Yeah, I'm afraid my answers are boring, but we didn't do any fewer or any greater deals. Our investment pace doesn't change. And we're a partnership of two people doing both tech and life science.
Perfect. Same number of deals. Eghosa?
I did 6 last year, and I did 9 the year before, so I was a little down.
Down 30%? Okay, yeah. Why don't you take some time off there?
I know I want to try.
Stu, what was your record for 2009 in terms of investments, whether it was companies you were directly involved in or companies you looked at?
Well, in 2008, we did 5 deals, which was pretty typical for us. 2009, we just did 1 new deal, and although we did probably 7 or 8 follow-on deals, 2009 was a year of supporting our portfolio companies.
So down 80% for you. So why did you do fewer deals this past year?
Well, it's a combination of things. I'd say the primary reason for us was that we have a limited amount of capital. We are getting toward the end of our fund, and we placed a lot of bets already, in bets in companies that we thought were interesting. Unfortunately, 2009 wasn't a great year for raising capital from other sources or for sort of primary business metrics either. And so what we found ourselves doing was looking inward toward the portfolio, trying to figure out which companies we let fail. We let a couple fail in 2009, and which we prop up. And that took up most of our resources. Now, as we move into 2010, we've got a pipeline full of new deals. So I think 2010 is going to look a little more normal.
How did you make the decision on which ones to continue investing in and which ones to let go?
Oh, it's painful. I mean, it's unbelievably painful. And I can't, I've never done, we do really early stage investing. So we do $500,000 type deals, and we're pre-Series A, and we get very involved with the founders of these companies. So these companies truly become our babies. And it's one of these conversations we always have, which is how much do we get colored by our relationship, our personal relationship with these companies. And we had a lot of hard discussions at the investment committee level. And it came down, I mean, at the end of the day, it became fairly simple. There were some companies that were just eating too much capital, not showing enough promise, that we just didn't want to support anymore. And we let 2 companies go last year that sort of met those criteria.
So how did you become a baby killer?
You know what? When the founder calls you up and says, I know you guys have more cash, and why are you putting it in company B and not company A? You feel like that. Yeah, there's some tough calls.
Well, Eghosa, you didn't do quite as few baby murders as Stu did, I hope. Tell me about how 2009 was. You're down 30% on your deal making. Why fewer deals?
Well, so I think, first of all, Okapi as a whole, we were down quite a bit. We did, of the 107 deals we did last year, only 25 of them were new. I did 3 of those 25. Overall, I think what we found last year was, yes, it was a year of reflection. It was a year of looking inwards and trying to figure out the companies we were going to live in, which ones were not. I personally, when you see CEOs at the firm, will tell you I just didn't flinch. And we as a company have been known to stump on the accelerator in the down cycles. Because we always felt that sort of way, when you come out, they don't see your taillights. And so we felt the same way. Unfortunately, the really good companies that were executing, they feel like you needed money. And those that wanted to take money actually wanted terms that,
So they were. So the valuations were crazy. Huh?
Yes. And even when the valuations came down, they didn't come down far enough. When you're looking at Google coming down 50%, and some young company that is still on its way to double earnings, telling you that its valuation hasn't come down 50%, and it has a private, it has a liquidity discount that's not incorporated, that's a problem. So I think we saw that, and we tried to do, I think, as many deals as we could, but we did it. And you know, because we're a state agnostic investor, we will do deals from 100,000 to $1 billion. And so what then happens is you find some of the early stage companies, some of which I had, where some folks who are not necessarily married to how you manage an early stage investment, they're just willing to pull the plug. Because, you know, it's a classic saying, if you owe the bank $1 million, you don't sleep well. If you owe them 100, the bank manager doesn't sleep well, right? And so I think for the larger investments, you have guys who are less willing to pull the plug, whereas for the small ones, and you know, for me personally, I thought some of the small ones needed to survive past 09.
Didn't want to kill your babies.
I just really did not, you know, and I think I'm proud to say that I did it. You know, now 10 is going to be a different year. You know, some of them are actually doing quite well.
I'm sure.
But I think 09 was a tough year for everybody, and you know, the small ones were really hard, and it was hard. You had to double down on a lot of investments.
Sure.
That was just
Mark, what was your experience in 09? Did you have to do any baby killings? Did you find yourself stomping on the accelerator?
Neither. A measured, sort of controlled approach. It didn't have any companies that required follow-on, and the companies we've been blessed with are doing phenomenally well. We did, I guess, 2 new deals, which is about average for us. It'll be our 4th year in operation this coming May with 2 of us, which is about a deal per partner per year in a normal investment cycle. Nothing really changed. I think I did notice the NVCA statistics that the average amount of time of due diligence that venture firms were performing during 09 went from 9 to 12 months to 12 to 18 months. Now, partly that's because they could get away with taking longer because they had limited partner pressure to maybe not call capital as fast. Part of that was a sign of, well, we really need to make sure, we really need to understand it's a larger round. We have a syndicate, whether our syndicate partners have capital in a down market. Those types of dynamics.
Did you find that you had to take more time to evaluate the deals that you made?
No, we take the time that we take. We do a lot of our diligence. We have strategic investors at the corporate level from the technology and the life science industries that are public companies. We tap them for diligence, and so our process doesn't really change either way. And even on the prospective deals, we believe we need to earn the right to invest, and so we invest a lot of time up front getting to know the management team, the founders.
So if somebody pitches you tonight on an idea, how long should they expect before they get an answer about whether or not you would fund them? By midnight?
Depends on what they
the
do.
idea. But if you do your regular diligence process, if it looks like if it's
Well, I'll give you an example. You said that be as specific as possible, otherwise I would have never just thought of this, but I started looking at a particular company called Second Voice in July last year, and met with the CEO and the founder and started the process, and we closed the deal December 9th. And it was, you're doing that in parallel to sitting on boards and other type of activities. So we move pretty fast. I mean, we're an investment committee of 2. We've got, mutually assured destruction. If I veto one for deals, or it's for business fundamentals, not because of the biology or science, and the same is true on the tech side.
It's a nice partnership to be a part of.
Yeah, and we've got a solid LP advisory committee for very sophisticated investors that we can tap to if need to. We haven't had to yet, but I'm sure we will at some point.